Hi, I'm Phil Grande, philstake.com. Welcome to my YouTube channel and the stock market crash unfolding. Okay, this week we've got more and more evidence that we're getting closer and closer to the crash. This is unbelievable evidence. This is probably one of the best evidence we've gathered. Let's take a look. Okay, first of all, this is the stock market since 2012, okay? 2013 when they started doing all the tech stocks, all the big tech stocks. That's what's been moving the market, all the big tech stocks, okay? Finally, what's happening is we're getting now a spike. We're getting a little spike here. See the spike right here? What does that tell us? Let me show you what the spike shows you. When you take this out of here, let me move it out for you. And watch this. If you can see right here, there's a spike right here from this point right here up to here. See that big spike? Now, what does that mean? Okay, this is very, very important. We know every time when a market fails, when you're going to a crash, we witness the same thing every time. What is that? Okay, that three things spike at the same time. One, right here, red, margin debt. And we got tremendous margin debt, over almost $900 billion in margin debt. The next thing that's spiking is the S&P, right here, the market. The next thing that's spiking is the housing market. So the most dangerous and the biggest evidence you can see that's telling you we're getting closer is when all three spike very sharply at the same time. And that's exactly what we're seeing. Exactly what we're seeing. The other thing, what we're seeing is that in margin, the margin debt is so dangerous. When you start seeing that people start coming in who otherwise are never in the market, who for 13 years they've been out of the market, and all they've been hearing is about the same five FANG stocks over and over for 13 years. Facebook, Amazon, Google, Netflix, Apple, those FANG five. They hear those every day. They go to bed hearing those every day. But 13 years they stayed out of the market. Finally, they can't stand it anymore. And when they can't stand it anymore, they come in and they borrow money on margin. Why is that so bad? Because here's the problem. As they come into the big tech stocks, when they come into the big tech stock, what they don't understand is there's a rotation out of the tech stocks. The big boys, the institutions that already made their money in the tech stocks, they're rotating out. They don't realize it. So they're getting in because they haven't been in the market in 13 years. And all they keep hearing from the fake business news network, how unbelievable our economy is, how we're going to grow 10%, how we got this big boom going on. And all they do is come in and get into the stocks they've heard over and over and over for 13 years. But what they don't realize is we have the big guys, they're moving out. The big hedge funds are moving out. The banks are moving out. The insurance companies are all moving out. So why it gets so dangerous is because all of a sudden they'll start panicking. This is how the market starts to crash. So they owe $900 billion. All of a sudden they're panicking because they see the stock going down. So they see the big tech stock going down. They panic. All of a sudden they get a margin call. They'll get a call from the broker. You got to send me a check for 10 grand or 8 grand. They say, oh, no, I'm not going to do that. Just sell my stock. And when he says sell the stock, then the next guy says sell my stock. And what turns into a little correction turns into a downward spiral, which turns into a bloodbath. Happens every time. This is the evidence we're seeing right now, right here, right in front of us. Unbelievable. This is unbelievable, this evidence. That's what's going on right this moment. Now, the bubble. This is the big bubble right here. See this? Now, the difference between a strong, sustained stock market and a weak, unsustainable market is right here. When you have a good market, okay, when you have a good market, what you do is you first put in, and everybody will tell you this, business investment. It's always business investment. That's the first thing right here, business investment. CEOs pile money in business investment. And from business investment, you get productivity. From productivity, you get good wages. Good wage increases, you get good savings. From savings, you get spending and small business startups. And then the economy grows. The standard of living goes up. That's a beautiful thing. That's how you get sustained market, sustained growth, okay? But guess what? They're not doing that. Since 2008, they've been propping the market up since 2008. They first went in with $4 trillion to do QE, to buy treasuries to bring those rates down to zero, and to do stock buybacks. And here's this: they did 6.5 trillion in stock buybacks to prop it up, hold it up, so that when earnings come in terrible, that means they have fewer shares. So when they spread their terrible earnings over fewer shares, that artificially pushes up earnings that otherwise would not go up, and then that pushes up the stock price, which otherwise would not go up. It used to be a felony to do that. Then another $7 trillion to prop up the market. To go and they print the $7 trillion. They go and they find the companies that are falling apart, maybe go into bankruptcy. The Federal Reserve goes in, buys all their debt, buys treasuries to prop them up, hold them up. Then finally, Biden, stimulus to hold the market up. Remember, stimulus is a crutch. Stimulus identifies a very bad economy. That's like a lifesaver. You're on life support. And then finally, $9 trillion to prop up this market. This is what we have where they're telling us is the big boom. $9 trillion, which started back here in 2019, because the banks have been falling apart. So look at this. This is our stock market that they're telling us is fantastic, that we're going to grow 10%, all propped up, all fake, unbelievable. This is what we don't have. What will trigger this market, and remember what I am telling you right now, what's going to trigger that market is right here. What's going to trigger it is this spike right here. It always does. That spike always is. Every market crash I've been in, same thing. When you get the margin debt, you get the S&P, and you get the housing going up at the same time. That is a big signal. I hope you like this. Please say you like it, and also like and subscribe. And one last thing I'm going to show you before I leave. The one thing I've been doing with my gang members all week, showing them how to rotate their stocks. Now, with what is going on with this propped up market, we're close to a crash. What we're doing is we're taking them out of the semiconductors. Big money is coming out of the semiconductors right here. See it? The semiconductors are going down. So we're rotating them into cyclicals like McDonald's. See them going up in green? We're taking them out of Netflix, which is going down. We're putting them into stocks like REITs that are going up. We're taking them out of the airlines, which is going down, and we make sure we're putting them in gold, mining stocks. This is what we do. We make sure our members always are in those right stocks. Look, please do me a favor, okay? Please hit like and subscribe, and next week we'll do more of this. And I am telling you, this bubble, please believe what I'm telling you. I'm taking a little extra time, but I can't tell you more. Just look at this. This is the bubble. And the biggest thing, the biggest evidence is right here, this spike. Oh, we are getting so close. But remember what Powell's doing. He's doing everything to try to expand the bubble and to put off the crash. And the stimulus will do that. But don't worry about it. Then we'll make money, with, like I said, by rotating into the power stocks. But we will be ready for this crash when nobody else is. Okay? I'll see you on the charts.